Good evening. We will switch to English for this conversation. Also, a very warm welcome from my side. Thank you very much for the interesting talk we just had. Rainer Hank mentioned that we will celebrate the 5th anniversary of Lehman Brothers this year. Actually, we just had 2 anniversaries only a few weeks ago. 3 weeks ago, it's been 5 years since Bear Stearns had to be rescued. 5 years since we've had this general mode of crisis, this general mode of uncertainty, and a rather distant memory that we all have of the times before 2007 when everything seemed so nice and calm. But we've also had 4 years of an equity bull market, 4 years of a bull market in many risk assets. What now? Today and tomorrow we want to shed some light on these big questions that every one of you as active investors are confronted with. And I'm very delighted to welcome Elizabeth Corley with me for this first talk. Elizabeth Corley is CEO of Allianz Global Investors and member of the executive committee of Allianz Asset Management. Prior to joining Allianz in 2005, Elizabeth spent 11 years at Merrill Lynch Investment Managers, where she was head of the EMEA Asia Pacific Mutual Fund business. She was named Most Influential Woman in Asset Management in 2009 and CEO of the Year in 2011 by Financial News in London. She's also an acclaimed writer, and mind you, she's not writing investment books. She has published 4 thriller novels, and she has just finished her 5th. Deadline to hand it in to her publisher will be in 2 weeks. Elizabeth, it's a pleasure to have you here.
Thank you, Mark, and thank you very much for the opportunity and the invitation.
I would like to start with a quote from Bill Gross, the bond investor of PIMCO, who works for you. PIMCO is a part of Allianz. In his last client letter, rather humbly for once, he wrote, "What if we just had a great 30-year epoch of credit expansion that defined investing over those 30 years? And what if we have seen the end of that epoch? How does an investor adapt to a new epoch?" Elizabeth, would you agree that we might be really at the beginning of a new epoch in investing?
I think this is a very complex and multi-leveled question. There's no doubt that in the Great Moderation, we had a wonderful secular bull market for bonds and a relatively benign environment for equities. So most of the people in this room who are over the age of 40 had a wonderful golden period for themselves personally and also for the clients. Is that golden period going to immediately repeat itself? Absolutely not. Does that mean it is a new epoch? Well, if you look at some of the research that's been done, and I'm thinking of the Reinhold and Rogoff research that they did, which I'm sure many of you are familiar with, what we see is that throughout history, you have these cycles of liberalization of capital movement, which leads real economic growth, which then leads to some sort of crisis, which then leads to constraints on free capital movement and into more of a decline. And this is what we're seeing at the moment, that we're seeing through pro-cyclical regulation and elements of protectionism creeping in, plus risk aversion, free capital flows are being significantly reduced. And the previous panel talked about financial repression. That will undoubtedly accelerate this decline. So we're definitely in an era of subpar economic growth, particularly in developed markets. But we're also in an era of liberalization of markets in some of the what used to be called emerging economies. I think they're emerged. Let's call them fast-growing economies. This is indeed new. And I do think it means that we have to think about how we look after clients' money differently.
So in general, you would agree that we're in a new normal environment. One of the attributes are In developed markets, slower growth.
Or an old normal market. I mean, I think you have to look at these things in rotations. And it's very interesting when you look at the start of the Great Moderation. Most people say it started around 1981, 82. If you look at the PE ratios for equities, they were less than 10. If you looked at the yields on bonds, they were above 10%. So what we actually had was, I would say, a great normalization, a reversion over that period. And then, as always happens, sadly, we don't learn, we significantly overshot. And we've overshot on the downside now. So it's definitely true, I think, for advisors and for asset managers, you absolutely have to be looking for real yields after inflation, real returns, real income flows, and find them wherever you can. And the old days of saying, oh, well, that's easy because this bond's going to do okay, and equities generally are benign, those days have definitely gone.
Now, as you mentioned, most of us in this room have had our formative years in investing during that benign time, between roughly 1982 and 2007. Some of the basic tenets we learned during that time was there is something like a risk-free asset. Mm-hmm. Is that still something we can grip?
The only reason we have anything that's potentially risk-free is because of financial repression. Because we have governments, policymakers, and with the help of central banks, intervening in the distribution of capital and the distribution of risk in markets. We heard in the earlier panel session what's happening in Europe. It's happening everywhere. The smart, safe, easy way for governments to get out of the debt burden they're in is to engage in financial repression and to ensure that their debt gets purchased.
So just so I get it clear, financial repression is already a fact.
Absolutely. Absolutely, it's still a fact. If you look at the pro-cyclical nature of regulation, Basel III, Solvency II, you look at what's been happening in terms of IFRS accounting development over this same period. You look at central banks purchasing their own bonds. You look at the way in which spreads on sovereign debt have narrowed and are being managed, and look at the interest rate levels. Financial repression is a reality, and at the moment it's being managed without the inflationary risk. We fully agree with the lady economist who was speaking earlier. The mid-term outlook for inflation is pretty benign, but inflationary expectations are rising, and there is a great element of trust being placed in the quality of central bankers who are a new regime from the previous central banks. The idea now that you could have anything beyond an inflation target or monetary supply target is anathema to the previous generation of central bankers. So what we need to see is whether we moderate out of this era of financial repression. We think we're here for quite a long time because of the scale of deleveraging and because of subpar growth generally, particularly in developed markets.
When you say quite a long time, your best guess, how many years of financial repression will we have to suffer or endure?
Let's think about how long it takes to get out of the debt burden that we have, whether it's on central bank balance sheets, and we know that the British balance sheet is 5 times what it was. We know that in the United States it's approaching 4 times. Even in Europe, although the total money supply in Europe is something we need to think about because there's been bank deleveraging, but even in Europe we see 2.5 times. This isn't something that goes away in an instant, and we don't have global growth. I was heartened to hear that 2013 is the year of the real economy. I do hope so. But for a real economy to thrive and grow, it has to have real investment. We have to see a money multiplier effect from the quantitative easing. And there are too many uncertainties. No, we're not. We're seeing instead a lack of confidence and a lack of trust. And if we don't have confidence and trust, people do not deploy risk capital to work, whether that's an individual saver, an advisor on their behalf, a pension fund, an insurance company, or corporate boards who have very significant cash sitting on their balance sheet, and the shareholders saying to them, return it to us either as dividend or share buybacks because we're more certain that we can use the cash. In all those environments, that means that we have a situation of subpar growth, weak and fragile recoveries happening, but fragile. In 2007, we said we thought it would take 10 years to get through the worst of the crisis. We're now halfway through that. And we're now saying, to answer your question, we think it's probably another 10 years. Now, there are some upsides in the faster-growing markets. There's upside in the improvement in labour unit cost in the peripheral states in Europe. There's upside in the way in which the US labour market has always reacted most quickly. So there are some positives, but there are also some huge unknowns. We don't know what's happening because of the Japanese change in policy last week, for example.
I'd like to stay on the topic of financial repression for a while. I read in a report this morning, I don't know if the number is true, but it sounds big. $20 trillion of fixed income market cap currently trades at yields below 1%. Of course, that includes most of the Japanese outstanding debt, US debt, German debt, Swiss debt, and so on. But it's a huge number.
It is a huge number, and then you talk about how should risk capital be put to work, and we find that it's being put to work to reduce sovereign debt. So for people who, if you like, have done the right thing all their working life, are approaching retirement, pension funds with those liabilities, insurance companies with those liabilities, the burden of finding a real return, sometimes reinforced by a regulatory requirement to do so, has been put squarely into the private sector.
So these so-called risk-free assets, safe government bonds, I mean, do they still deserve being called risk-free?
According to Solvency II and Basel III, there's no problem.
But they have negative yields, real and even nominal.
As we have seen very recently, I mean, really quite a surprising effect of seeing the Japanese policy, seeing now nominal negative returns, as you say, and this flight to safety, and the unintended consequences of policy missteps or even casual remarks. One of the issues we face is because we've got this blurring between monetary and fiscal policies, because we've got a situation where political intent is very closely linked to economic prospects, anything that happens is magnified by the way in which the political establishment as well as the European institutions react. And so all it takes is one small comment that a guarantee on your deposits with your bank is only as good as the government that gave the guarantee. One small remark like that sends a shockwave, and you see further flight to high grade or higher risk-free areas and a depression in yields.
Now, when we once learned that we can base everything off this risk-free asset, and when I see how many insurance companies, pension funds, and so on are, by regulators, being forced to hold these, what should we as investors do to really not get eaten up during this time of financial repression?
Well, I think there's so many things that can be done with private assets and private wealth that can't be done within regulated systems. So the first thing is, if people have their own personal savings, I really do believe they need good quality financial advice, because this is a time when asset allocation, agile, broad asset allocation is absolutely key. It's very, very difficult to be an expert in all the sources of potential real return. And therefore, having somebody to work with who can really help find these sources of real return. People should also be looking for inflation plus return. They should be looking at total return, including the dividends on equities, which have been very reliable. One of the advantages of the current markets for equities, which many, many private investors and pension funds and insurance companies have missed out on, is relatively low volatility. If you look at the correlation between volatility in equities and interest rate and the monetary supply, we are actually in for a period of reasonably low volatility. Unfortunately, the thing that really changed in the financial crisis was trust and confidence. And I think it was Robert Reichs, who was a previous Secretary of State for Labour in the United States, said we don't have a liquidity crisis, we have a confidence crisis. Financial systems are driven by confidence and trust. And if we don't see that confidence and trust, people sit on the sidelines, fail to make decisions, and are apathetic. And therefore, the biggest risk people are taking is the risk of inaction. and the risk of leaving money in negatively performing bank accounts.
Basically the risk of not taking risk.
The risk of not taking risk is now the prevalent risk in the markets.
If I generalize, quite simply, central banks are forcing me to take risks. They want to force me out of my comfort zone of safety and take risk.
Once you've put significantly amount of money in the sovereign bonds, yes, then with the rest of that money you should go and take risk. But actually that's healthy. That's very healthy for free capital flows to start going into emerging markets, into good companies with high-grade credit opportunities, decent spread product, and equities with dividend returns. That's very healthy for the real economy and hopefully a real result of the economy.
Where do I find the interesting opportunities that are still attractively valued today?
Well, I think that's why you've got to be either an expert investor or linked to somebody who can do that for you, because the sources of real growth are not predictable, and you've got to be pretty agile, because when you get policy distortions in the markets, you can get pricing distortions which are not driven by fundamentals. So you've also got to be quite active in your asset allocation. But if you look around the world, you can see, first of all, if you've got to hold bonds, if somebody wants a safe profile, you can do more by being flexible in a bond portfolio, having more spread product in there, having some emerging market bonds in there, potentially having emerging market currency exposure. We also believe for institutional investors or investors who can benefit from an illiquidity premium, there are great opportunities in infrastructure, the right sort of property. Obviously, there are always going to be bubbles in the current environment with low interest rates, so avoid property in markets that are lagging, but there will be property opportunities that are decently priced, and some forms of venture capital, private equity. These are all really interesting returns.
Do you see asset classes, sectors, which already show signs of bubbles?
I think if you look, I mean, there are usually clusters of bubbles. The question is whether they're going to be contained or whether they're going to have systemic knock-on effects. And we believe we're much more likely to see smaller bubbles that don't have systemic effects other than short-term shock. So you could argue maybe Chinese property is an obvious one. There are people out there who feel very strongly about gold, but remember we're in very strange times and gold has a sort of mythical capability as well as an asset value. So these are areas, probably certain elements of emerging markets which have been overbought in recently, they'll come back to good value. So timing going into some of the emerging markets and some of the EM currencies. But these are probably micro bubbles as opposed to macro.
Now, when we talk about financial repression, it's not something that has never happened before. We've had a time of financial repression during the 50s. What should we learn from that time in terms of how we should act, how we should build our strategy?
There's some very interesting studies that have been going back to look at the 50s and even the 30s. What they see is that one should assume that as and when we move out of this era, when the quantitative easing slows down and stops, clearly bonds are going to underperform. It can be done in a way which isn't totally value destroying. It can be done actually in a way where there's a very, very managed slowdown and with modest interest rate rises, which is benign, slightly positive, but generally bonds underperform. Provided we avoid hyperinflation, equities typically outperform and risk assets continue to perform.
So basically this benign scenario hinges on our trust in central bankers doing just the right moves at the right time.
Exactly. I mean, there are many, many, many policy decisions to be made and it's highly complex. And you don't suddenly stop, for example, in the United States, buying 85 billion a month and expect the economy not to stutter. So I think it's going to be very, very careful how it's done. I think we have the advantage of very strong technical thinkers at the heads of many of our central banks. That's a huge advantage. I know there's a lot of debate about the extent to which there is central bank independence, but even if one accepts that we now do have a different mentality among particularly the Anglo-Saxon banks and now the Japanese, and they are leaning into the situation, even if one says that, they're hugely responsible and thoughtful and connected. So I think from a banking point of view, we would say we have fortunately got the technical and technocratic competence that we need. The bigger issue is actually the political environment, because we still largely have democracies in the developed world. Democracies can only take so much austerity and so many failed promises. And we know that fiscal policy cannot return us to a state of balance now because we don't have growth. So the big risk is if we find that there are political interventions, and that can come through regulation, which make it very difficult for us to wean ourselves off the drug of quantitative easing.
You mean political intervention into into monetary policy?
Well, I think, just think about it. If you think about what's happening in the moment on regulation, and one can see exactly why it's happening, if ultimately the taxpayer has been the ultimate risk taker, you can see why politicians on the taxpayers' behalf, on voters' behalf, want to stop that happening again. And so you can see also an element of wanting to eliminate risk for the individual at exactly the point you made, at the time when the individual needs to take the risk. So what you find is that typically regulation is narrowing down the ability for institutions to take risk, not just through bank deleveraging, but also through product design, through compensation structures, and other things. So if we started to see a wave of regulation coming through, which was well-intentioned, but actually further distorted the flow of capital, that would be an unknown effect, which we haven't lived with in the last 5 to 10 years. And we wouldn't know, the central bankers wouldn't necessarily know or be able to predict what that regulatory response would be, or policy response would be, at a national level. And we're still dealing largely at national levels. We don't have the risk transfer mechanisms, even in the Eurozone, in place yet. Plus, you've also got to have the political will in the larger markets to continue to do some difficult things and to face the electorate. Now, once we get through election cycles, there's usually a honeymoon period of 1 or 2 years when the right things can be done. What we've seen, without pointing fingers at any particular market, is that sometimes that honeymoon period reduces to less than a year. Mm. This is a very difficult scenario in which any policymaker or any central banker can predict the timing of how to move from our current situation.
Now, some people argue that, if I take the US central bank, the Fed, basically, Alan Greenspan dealt with the burst. Basically, Alan Greenspan has blown up the tech bubble, let it burst, and dealt with that burst by inflating a real estate bubble. Then that one burst, and now Ben Bernanke is trying to inflate another bubble. What do you make of that?
I think, quite honestly, I think that's really simplistic. I think if you look at what was happening in the dot-com boom, it was a classic, narrow bubble where people were talking about paradigm changes, and it wasn't. And there was a reversion to the norm, and we did not see a real systemic risk. We saw a confidence shock, and we saw real loss of value for individual investors and savers who trusted, but we didn't see something which was systemic. Similarly, if you go back to 1987, when we see stock market crisis then, letting a bubble burst is not a bad thing to do. Creating a massive bubble which gets beyond the point at which it can be burst without financial systemic risk is a difficult and very different situation. So I think these very simplistic comparisons are not helpful in looking at what's really going on.
And you don't see the risk that we are right now seeing the process of a creation of another bubble?
Well, we know that there is a technical bond bubble. We know that. But it's underpinned by very strong policy. So it's a bit like controlling the price of an asset. If you control the price of an asset, the bubble can't happen because the price is controlled. So it's really about how we move from where we are now to a more free movement of capital over the next 5 to 10 years. And I do think that's very important, coming back to this point about where do individuals invest, because that means that the quality of advice they need and the discussions around risk, return, and appetite for volatility become hugely important, because we will see a bumpy ride. So we need to know the extent to which both institutional and individual clients have got an appetite for an element of volatility, or the extent to which they have zero appetite for accounting or regulatory reasons. And then I think what we have to do, and we do this, is you have to model different scenarios with clients, different inflation outlooks, different interest rate outlooks, different FX outlooks. Model that and see the extent to which the current portfolios are actually resistant to the shocks that might come and the combination of shocks. And that's the sort of thing I think that advisors and asset managers just have to do as part of looking after client money these days. It's part and parcel of what we have to do. It's not just investing the assets, it's helping the client understand the risks associated with that, the expected return, and the what-if scenarios as and when we start to see shifts in policy.
I'd like to get back to something you mentioned briefly. You described current monetary policy to a drug which financial markets are living on and maybe getting addicted.
Or life support would be another way of describing it.
When I look at how markets have dealt with the Italian election, which was almost 2 months ago, remarkably calm. When I look at how markets are dealing with the North Korean crisis, remarkably calm. Could those be signs of dangerous complacency?
I think they're more signs of fatigue than complacency. If I'm listening to our clients and our advisors, I don't think there's any complacency. I think people are hyper alert to information flows, hyper alert. But I do think that there is just a certain fatigue. You get battle weary after a while. You can't go through every single crisis, every single day with the same peak of emotional reaction. So I think that is almost a little helpful, provided the experts don't become complacent. In other words, a dampening effect of headlines on markets is quite useful.
What's the end game of this all? We have this uncharted territory where central banks are on now with their balance sheets. We have the hope or the scenario that they'll just pull the right levers at the right time. What's your best guess over the next years in terms of inflation, for example? Will we see an end game of this huge pile of debt being inflated away at some point, like some of the other panelists have said?
We are already seeing a modest inflationary eating away, but we're not seeing hyperinflation. And the real question is there a significant probability of hyperinflation? And as your previous panel said, that's impossible to predict right now because we're in unknown territory. At the moment, that is being avoided. I also think we shouldn't ignore the role of the private sector in this, of what financial institutions and advisors can do in helping for their clients to get through this and to think about these risks and to be ahead of the curve on those risks rather than takers of them. And I do think one of the things we have to do in the background to all of this is work out how confidence and trust are genuinely sustained in terms of the way in which financial institutions and advisors engage with their clients, the long-term nature of investing, issues around stewardship and governance. All of these matter not as much as the macroeconomic, but they will sustain an improved approach to belief in capital markets, if you like, belief in a market economy. If we don't do that, I think in the United States we don't have to worry about belief in a market economy. In China we don't have to worry about it. But closer to home we do. So there are some things we have to do as a financial sector to create the environment where there is, if you like, institutional trust that the financial sector can be responsible for helping of a way through this rather than it just being political or central bank dependent. Having said that, clearly with the scale of quantitative easing we've got, with the subpar growth we've got, there's no way we can get through this without some very thoughtful and carefully planned policy manoeuvres.
Now, you mentioned one issue that I think has touched the nerves of many in here. You mentioned how Solvency II, for example, is forcing institutional investors to hold government bonds, for example. Was that a huge mistake?
It was pro-cyclical, and
That's a yes, I guess. Right?
Well, let's think about it. In 2007 and again in 2011, how close were we, and particularly in 2008, how close were we to a situation where without a massive injection of money, the system would have frozen? If we were at a point of collapse then, and if the only way through that was that massive injection, we're now dealing with the consequences. These are second and third stage consequences of avoiding the abyss. Were they mistakes? Are they mistakes now? Yes, because clearly we're not putting enough productive capital to work. We have an aging demographic in Europe and in many developed markets, which is a serious problem and would have been a serious problem even without quantitative easing. a serious demographic. We know from research that we've done that the older somebody gets, the less risk they will take, and which is quite smart because their economic productivity is reducing. So we know anyway that we would have had risk off in a demographic shift, but we now have distorted capital flows to supposedly risk-free assets. So I wouldn't go as far as to say it's a mistake because it's a consequence. It's a second stage or third stage consequence. If we don't reverse it, if we don't think about how we get some of that risk-bearing capacity back into the system, it's not just Solvency II, it's also IFRS and accounting rules, individual pensions regulation. It's very likely, particularly in aging populations, that we will have destitute pensioners because the state won't be able to afford the level and standard of living, and their private sector, their private savings rather, will have been eaten away by inflation. And so we have to do something about that. That is a policy need for the next 10 to 15 years. That's why I think financial institutions have to engage with governments for the long term about what we do about pensions benefits for developed. We do that with certain governments. You see governments trying to do this, trying to do the good, even if the ability to fund that is reduced, and really thinking long-term about the best way of constructing pension portfolios, the best way of really constructing defined contribution solutions that, whilst at the same time putting some of that burden onto individuals, it's done in a way that's really thinking about volatility and risk and how we can dampen the effects of, if you like, risk aversion, which people will have, without at the same time pricing in the full cost of the guarantee. We know we can't afford to put the full cost of guarantees for annuities onto life assurance balance sheets anywhere in the world. It would bankrupt the life assurance industry. My company is in a very fortunate situation to be old and with a large surplus, and there are certain Swiss companies in a similar situation, but around the world generally there isn't enough capital to underwrite those full annuity guarantees. So we have to do something to start that burden sharing of risk in product design, in the fees we charge, in the quality of the advice we give, and then in a regulatory environment that means that there is stability for people to save for their older age.
What's your biggest worry today?
My biggest worry? Honestly, my biggest worry is always how we're performing for our clients. That's what I think about if you ask for the first email I look at in the morning. The biggest worry I've got is that probably the consequences of piecemeal, uncoordinated regulation are just not factored into anybody's equation. I don't know if you saw Andy Haldane's speech about this this week. That's probably where I'm concerned, because there are random attempts in micro ways to solve a problem. Nobody knows the cumulative effect of it. And sometimes that regulation is motivated by very different reasons than solving the economic issue that we face. That would be my biggest concern, because the consequence of that is we do not get growth back quickly enough and sustainably enough. And that's the underlying need we have.
And last question, what makes you feel confident that this will all work out fine?
Probably meetings like this, the people in this room, the professionalism of people. I do think we have a lot of professional talent in the industry and in the key institutions. That's the thing that gives me the most confidence. And I also do believe in the entrepreneurial animal spirit. I do believe in free markets. I know that's being tested and significantly challenged at the moment, but I think that's inherent in human beings, and that animal spirit gives me probably the biggest source of confidence.
Elizabeth, thank you very much.
It's been a pleasure, thanks, Mark.
Unfortunately, our time is up already. I could have gone on for longer, but in the interest of time, please join me in a big round of applause for Elizabeth Corley.